All right, Jay Powell didn't lift a finger. Interest rates stayed unchanged. I think they will for the rest of the year. Let's talk about this. John Carney, Breitbart economics editor, co-author of the Breitbart Business Digest, and our own Taylor Riggs, co-host of the Big Money Show, my favorite. Thank you to both of you. On the market, Taylor, the market was up almost 500 points at one point. Then it closed, I think, the Dow plus 87 or something like that. But that's a pretty big swing down at the close. Do you have any idea why?
I know. So John and I like to joke about this. The first move is usually always wrong. So don't believe what you hear in the first move. Let Jay Powell get through this statement, the conference, and then have the market digest a little bit. That's when the S&P and the NASDAQ rolled over into the red just a little bit. The Dow ended up just in the green slightly. I think overall the initial reaction was, this is great. Powell says hikes are totally off the table. And I think later on when you read the news, you sort of understand. He thinks policy is restrictive and that rate hikes are unlikely, but for the most part, they will hold. It is higher for longer. If rates are higher for longer and we're not getting cuts anytime soon, I think that's sort of that other hawkishness that came into play today. Higher for longer. I like that. That's a complete change.
Yes.
A complete Fed change from the forecast in the fourth quarter of last year and the beginning of this year. Why, John? Why? You mean did the Fed get something wrong?
Yeah, the Fed thought that inflation was going to keep coming down. In fact, they were ignoring the evidence that it hadn't been coming down since last July. We've been talking about this for months and months. Inflation wasn't coming down, which created the risk, once it's not going down, that it's going to go back up, which is exactly what happened. What the Fed did that was very important in the statement, forget about Powell's press conference, in the statement they said inflation's gone the wrong way. That they acknowledged
they said
that.
So,
yes.
All right, so that's
said,
a very big deal.
It's a big deal. They put it in the statement, said that there's been a lack of progress on inflation over the last few months, which is basically just Fed speak for saying, we got it totally wrong. It's going the wrong way. We're not going to cut. Powell also added that that it's now going to take longer to convince them. So if you thought it was going to take them 5 months a couple months ago, it's now going to take them a year. I don't think we're looking at, you said not this year. I don't think we're looking at rate cuts, at least until midway through next year if inflation goes back down.
So they might have to hike the rate after the election.
I think
they won't hike it before. But they'll hike the rate after the election. Could be November, December. I mean, if you're running, let's just say, argument's sake, if you're running at a 4%, I mean, take the CPI and meld it into the PCE and all the rest of these indicators. Maybe have a look at commodities, which have been rising, and gold's been rising, and blah, blah, blah. If you're running a 4% inflation rate, they're going to have to be, at some point, more restrictive. Now, as a technical matter, viewers, hold on. Their balance sheet, which they had been shrinking, I mean, selling, he said no more today.
Okay, well, and we'll make this interesting.
Or something.
Something.
The hell of an assignment.
QT is the balance sheet. It is the pace at which we let bonds roll off
quantitative
the balance sheet.
tightening.
Correct. It's a way to also tighten up the
money
economy.
Supply. Yeah, okay.
So traditionally in the past, we've been letting bonds go off at about $60 billion a month. The market thought that we'll slow down on that, do less tightening, ease up a little bit, and only let $30 billion of bonds roll off the balance sheet. They came out today and said, actually, we're only going to let $25 billion roll off the balance sheet. So what that means is they're not being as restrictive. They're keeping a balance sheet, easier balance sheet, which helps sort of the liquidity and the money markets. I would just also note, tell me if you disagree.
Why'd they do that?
I think they're worried about something going on in the banking system. I think they know that they're reversing on rate cuts. And they remember what happened last April when we had Silicon Valley Bank collapse. And I think they're worried about another run on the banks. And so they're wanting to provide more liquidity.
That balance sheet, which is the basis of the money supply and so forth and liquidity, that thing was $4 trillion pre-pandemic. It ran up to $9 trillion, okay, and we got a lot of inflation from that. Now, they brought it down to about $7.5 trillion, but that's still a very liquid position. I mean, how tight, if inflation's going up, how tight can they be?
I think, remember, it used to be zero. They used to have almost no balance sheet at all before we started doing quantitative easing after the financial crisis. A lot of people thought that someday we were going to get back to a normal Fed balance sheet, which is close to zero. this is an acknowledgement, I think, that they can't do it. They've locked themselves into a permanently expanded balance sheet.
It's like a woke monetary policy. Really, they're not tight enough. Interest rate hikes, probability. Seriously.
It's a non-zero probability,
All right,
like you've
but
said, and you've said
still,
this as well. I wouldn't rule it out. And I think Jay Powell today said January inflation was higher, February inflation was higher. Those are one-off data points, but now we've had a full quarter of inflation higher than expected. So I don't think that they want to come out and admit rate hikes, but I don't think that it's 1,000% off the table.
John, last moment. What is Joe Biden? Joe Biden forecasted rate cuts. He did it at least twice, maybe 3 times. He's going to be very disappointed. You think he'll attack the Fed?
He is very disappointed. It's going to take a lot of restraint. Fortunately, he has all this campus chaos he has to worry about. That might take his attention away from the Fed. But I think the Fed is actually going to have to start to prepare the market for a hike. They have said, Powell just began it today by saying, not by saying Fed hikes aren't off the table, they're just unlikely. That's a big change.
That's an interesting.
And I think they are moving towards starting to prepare the markets for a Fed hike. They better start doing that very soon. If Donald Trump gets elected and the day afterwards, there's a Fed meeting the day after Election Day, the day after they say, oh, we're moving to hikes.
Yeah.
That is going to cause a political explosion.
No,
they better not do that.
He won't mind that in November. He won't mind that in December. He will mind it a lot in January when he gets inaugurated.
When March comes around and they do the hike, then he's going to...
He will have something to say about that, as he has in the past. John Carney and Taylor Riggs. Folks, you must catch Taylor, along with her co-host Brian Brenberg and Jackie DeAngelis, on The Big Money Show, weekdays at 1 p.m. Eastern, right here on Fox Business. Terrific show. Thanks to both of you. Appreciate it.